started out, and for a long time, I used to do a lot of what Phil Fisher described. I followed this Scuttlebutt Method, and I don't think you can do too much of it. Now, the general premise of why you're interested in something should be 80% of it or thereabouts. I mean, you don't want to be chasing down every idea that way, so you should have a strong presumption. You should be like a basketball coach who runs into a 7-footer on the street. I mean, you're interested to start with. Now you got to find out if you can keep him in school, if he's coordinated and all that sort of thing. That's the scuttlebutt aspect of it. But I believe that as you're acquiring knowledge about industries in general, companies specifically, that there really isn't anything like first doing some reading about them and then getting out and talking to competitors and customers and suppliers and ex-employees and current employees and whatever it may be, and you will learn a lot. But it should be the last 20% or 10%. I mean, you don't want to get too impressed by that, because you really want to start with a business where you think the economics are good, where they look like 7-footers, and then you want to go out with a scuttlebutt approach to possibly reject your original hypothesis, or maybe and if you confirm it, maybe do it even more strongly. I did that with American Express back in the 60s, and essentially the scuttlebutt approach so reinforced my feeling about it that I kept buying more and more and more as I went along. If you talk to a bunch of people in an industry and you ask them what competitor they fear the most and why they fear them and all of that sort of thing, you know, who would they use the silver bullet of Andy Groves on and so on, you're going to learn a lot about it. You'll probably know more about the industry than most of the people in it when you get through, because you'll bring an independent perspective to it, and you'll be listening to everything everyone says rather than coming in and with these preconceived notions and just sort of listening to your own troops after a while. And I advise it. I don't really do it much anymore. I do it a little bit, and I talked in the annual report about how when we made the decision on keeping the American Express when we exchanged our perch for common stock in 1994, I was using the scuttlebutt approach when I talked to Frank Olson. I couldn't have talked to a better guy than Frank Olson. Frank Olson, running Hertz Corporation, lots of experience at United Airlines, and a consumer marketing guy by nature. I mean, he understands business, and when I asked him how strong the American Express card was, I mean, he could give me an answer in 5 minutes than I could accomplish in hours and hours and hours or weeks of roaming around and doing other things. So you can learn from people, and Frank was a user of it. I mean, Frank was paying X% to American Express for his Hertz cars, and Frank doesn't like to pay out money, so why was he paying that? And if he was paying more than he was paying on MasterCharge or Visa, why was he paying more? And what could he do about it? I mean, you just keep asking questions. And I guess Davey explained that in that video we had ahead of time. I'm very grateful to him for doing that, because that was a real effort for him. But that was really what I was doing back in 1951 when I visited him down in Washington, because I was trying to figure out why people would insure with Geico rather than with the companies that they were already insuring with, and how permanent that advantage was, and you know, what other things could you do with that advantage. And you know, there were just a lot of questions I wanted to ask him, and he was terrific in giving me the answers. It you know, changed my life in a major way. So I've got nobody to thank but Davey on that. But that's the Scuttlebutt Method, and I do advise it.
It's crazy to think anybody's going to be smart enough to husband money and then just come out on the bottom tick in some crazy crisis and spend it all. There's always is some person that does that by accident. But that's too tough a standard. Anybody expects that of Berkshire Hathaway is out of his mind.
Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. You know, it never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business. Obviously, if we could guess successfully a high percentage of the time where the stock market was going to go, we would do nothing but play the S&P futures market, where there wouldn't be any reason to look at businesses and stocks. So it's just not our game. We don't think what we see when we look at the stock market is we see thousands and thousands and thousands of companies priced every day, and we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's attractively priced to us as a business. Forget about the word stock. So when we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask, whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields. You'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments about what the futures of those businesses will be, and if we're right about that in those judgments, the stocks will take care of themselves. Since the Great Depression, I don't think you'll see an orchestrated credit contraction. Now, you had in 1998, in the fall, when long-term capital management got in trouble, you had a seize up of the credit markets. It wasn't an orchestrated by the Fed type contraction. You simply had people panicked about even the safest of instruments and credit spreads doing things that they'd never done before. And that's rather an interesting example, because that was not 100 years ago. It was less than 10 years ago. You had all kinds of people with high IQs in Wall Street. You had all kinds of people with cash available. And you had some really, really extraordinary things happen in credit markets simply because people panicked and they felt other people were going to panic. And you get these second and third degree type reactions in markets. We will see that sort of thing again. It won't be the same, but as Mark Twain said, history doesn't repeat itself, but it rhymes. And we will have something that rhymes with 1998. Number I would look for the person with passion for the job. I mean, the person that is always doing more than they're sure. You look for people that are good communicators and all of that sort of thing. But I like my way better. It's a lot easier just to take somebody that's been batting 400 in baseball and say, I think I'll stick him in the lineup. And the nice thing about our game is that, in baseball, unless you're Nolan Ryan or somebody, you have to hang up things at 40 or thereabouts. But in our game, they go on and on and on. I mean, I use as an example, we had a famous Mrs. B from the Furniture Mart, and she worked for us till she was 103. And then she left and she died the next year. And that is a lesson to our managers that Charlie?
Well, that was very useful advice. It reminds me very much of the late Howard Amundsen, and a young and starving business student once asked him for advice as to how to get ahead. And Howard said, well, I always keep a few $1 million lying around in case a good opportunity suddenly turns up.
We would be very happy if we could buy common stocks where our expectation over a long period pre-tax from a combination of dividends and capital gains, we'd be very happy if we thought it was going to be 10%. And we would probably settle for a little less than that. And there's no question, absolutely no question, that returns from owning Berkshire will be less in the future than they have been in the past. There's no question that we will not do as well with the common stocks at Berkshire that we own in the future as we have over the last really 40 years or thereabouts. We operate now in a universe of marketable stocks where we're talking about companies with market caps of at least 10 billion. In most cases, to have a meaningful impact on Berkshire, we're talking much bigger than that, maybe 50 billion and up. Well, that universe is not as profitable a universe to operate in as if you have the entire universe of thousands and thousands of companies. So if we just take an example, if we find a company with a market cap of 10 billion and we can buy 5% of it, and usually that's about what we could buy without disturbing things, we can have a $500 million investment. Let's say it doubles over a period of time. That's 500 million. You pay a 35% tax. You have 325 million. That's less than 0.2% in terms of Berkshire performance. So our universe has shrunk enormously, and we will not do as well in that universe remotely as well as we would if we were operating in a much wider universe and could do all kinds of things. We've found little things to do from time to time where we've made some money. I may refer to them a little later on a couple of things. And they're nice, but they don't move the needle very much at Berkshire. So anyone that expects us to come close to replicating the past should sell their stock. I mean, because it isn't going to happen. And, I think we're going to get decent results over time, but we're not going to get indecent results. And in this field, we prefer indecent, but we're not going to get them. Charlie?
I think you can take Warren's promises to the bank. We are very happy making money at a rate in the future that is way less than the rate at which we made money in the past. And I suggest that you adopt the same attitude.
Well, I wouldn't condemn him to that. I think if you're working with small amounts of money, I've talked to yeah, then you may have something very much better to do with your money than to buy Berkshire. I mean, if you're working with small amounts of money and you want to put in significant amounts of time and examine thousands of securities, you will find things that are more intelligent to buy than Berkshire. We still think Berkshire is an attractive investment over a long period of time. We think that it stacks up reasonably well with other very large companies. We don't think it's the most attractive investment in the world in terms of what you can find if you're willing to go through those thousands of possibilities, which is what Charlie and I used to do many years ago. It's not feasible for us to do it now, and it wouldn't have any impact on Berkshire. What we really like at Berkshire is buying good-sized to very large first-class businesses with first-class management and just sitting there. Because the nice thing about that is you don't have to go from flower to flower. You can just sit there and watch them produce more and more every year and give you capital, and you can buy more businesses. That's a nice formula. It's a formula that will work, I think, for us. It won't produce returns like the past.
Yeah, the students of America go to these elite business schools and law schools, and they learn corporate finance the way it's now taught, and investment management is the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But that's, there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. And we've had the chance to do that way in our past when we were working with small sums of money. We'll never get a chance to do that working with the kinds of money that Berkshire does. We try to load up on things, and there will be markets when we get a chance to from time to time, but very seldom do we get to buy as much of any good idea as we would like to.
You've just heard him on the subject. But corporate profits, when they get up to 8% plus of GDP, that is very high. And so far it has caused no reaction. One reaction could be higher corporate taxes. You have lots and lots of businesses in this country earning 20 or 25% on tangible equity in a world where long-term bond rates are 4 3/4% government bond rates. That's extraordinary. If you'd read an economics book 40 years ago and it talked about that kind of a situation persisting, well, you wouldn't have found a book like that. I mean, that does not make sense under pure economic theory, but it's been occurring for some time, and as a matter of fact, it's gotten more extreme. Corporate profits continue to rise as a percentage of GDP. That means somebody else's share of GDP is going down. And you're quite correct that the labor component of GDP has actually fallen fairly significantly. Whether that becomes a political issue, maybe in the next campaign, whether it becomes something that Congress does something about, Congress has the power to change that ratio very quickly. Corporate tax rates not that long ago were 52%, and now they're 35%, and a whole lot of companies get by with paying 20% or less. So I would say that at the moment, corporate America is kind of living in the best of all worlds, and history has shown that those conditions don't persist indefinitely. What brings it to an end when it happens, I don't know. But I would not expect corporate profits to be 8 fraction% of GDP on average in the future. Charlie?
Yeah, of course, a lot of the profits are not in the manufacturing sector or the retailing sector either. A lot of them are in this financial sector. And so we've had a huge flow of profit to banks and investment management groups of all kinds, including various kinds of private equity. And that has, I think, no precedent. I don't think it's ever been as extreme as it is now. Do you agree with that?
Yeah, and Charlie and I would have said 20 years ago, we've done things in banking from time to time, including owning a bank. But if you'd said to us, in a world of 4 3/4% long-term governments, will one major bank after another be earning more than 20% on tangible equity, dealing in what is basically a commodity money, we would have said that condition just wouldn't persist. Now, part of that is because the banks are geared up more. So if you earn 1.5% on deposits, and you have, or 1.5% on assets, and you have assets of 15 times equity, you're going to be earning 22.5% on equity. And by gearing up more, it does improve the return on equity. But you still would think that would be self-neutralizing. You'd think that after one guy did it, another guy would do it. And instead of earning 1.5% on assets, you'd earn 0.9% or 1% on assets. But it hasn't happened. That's gone on for a long time. And we are living at, I'd have to look at a chart on it, but there may have been a year or two post World War II. But I don't think that, I would bet there haven't been more than 2 or 3 years in the last 75 when corporate profits as a percentage of GDP have been this high.
Some of this has come from consumer credit, which I think has been pushed to extremes that we've never before seen in the history of this country. Some other countries that pushed consumer credit very hard had enormous collapses. Korea had one, for instance, that caused chaos for 2 or 3 years, maybe longer. So I don't think this is a time to just swing for the fences.
And that chaos in 1997 and 1998 when the IMF stepped in, I mean, it was bad in Korea for a while. It produced some of the most ridiculously low stock prices that I've ever seen in my life. In fact, I mean, you could go back to 1932 in this country and you wouldn't have seen things any cheaper. So, And in the meantime, the companies rebuilt their balance sheets and their earning power. So things do turn around in financial markets. You will, if you're young enough, you will see everything and then some. I mentioned in the annual report, in looking for an investment manager to succeed me, that we care enormously about finding somebody who's not cognizant of everything risky that's already happened, but that also can envision things that have not yet been experienced. That's our job in the insurance business, and it's our job in the investment business. And there are a lot of people that just don't seem to, they're very smart, but they're just not wired to think about troubles that they haven't actually witnessed before.
We have so much fun. I just talked to him the other day for an hour, and we have fun every time we talk. And we are doing what we love to do with people we love every day. And I've been lucky on health. God knows how Charlie in '96 and me at '89 with our habits and everything. It's I don't know what it's a testament to. I think actually being happy in what you're doing makes a huge difference. And you don't want to go around having grudges against people. And I mean, all these things that cause you to think negatively, whether it's about the world or about individuals or about your own bad luck or anything of the sort. Just forget it, basically. I think that helps.
How do you clear that stuff out of your mind?
I don't know whether you're born to some extent that way, but you certainly see that it works, Andy. You just take the people you know, and the ones that are sour on the world gets sour on, basically. And so it's, now it's got to be tough, and certainly if you've got some major illness or something of the sort, that's just, you can have terrible luck in life, and and it can seem very unfair to you, but you're going to have a better experience in life if basically you see the positive sides of things. People will see the positive things in you at that point. And if you can find some, I'd say look for the job that you would take if you didn't need a job. And if you can find that where you're actually, I don't think I've had a job. I would define work as doing something when you'd rather be doing something else. And when I sold shirts at Penny's and I was getting 75 cents an hour, I would rather have been doing something else. But since I've been certainly 24, there wasn't anything else I wanted to do. And I had everything I needed, and life was wonderful. And I tell the students that, you got to live. So you may take a job at first for some organization that you don't admire, or work for somebody you don't admire, but look for somebody you admire. Look for somebody where you're looking forward to working with them that day and doing something that you're looking forward to, that you'd do if you didn't need the money. And Charlie and I found that a long time ago.